Welcome back to our channel. So uranium has been making headlines recently. In this video, let's take a look at the fundamentals of this metal, and I'll give you some names of companies we like in the space. Alright, so let's start with prices. So in the last 6 months, uranium was up 90% to the current level of $106 a pound. The last time prices were at these levels were 16 years ago, back in 2007, when prices hit an all-time high of $148 a pound. In the last 10 years, uranium prices have averaged about $35 a pound. Now, the recent surge in prices can be attributed to two factors. Number one, rise in demand. Number two, supply disruptions. Let's take a deeper look at each factor. Starting with supply, the world's largest producer of uranium, Kazatomprom of Kazakhstan, recently came out said that their production for the next 2 years will fall short of their previous production guidance. Number two, the recent coup in Niger, which accounts for 4% of global production, also caused some supply disruptions. Most importantly, Russia accounts for 35% of global supply of enriched uranium, which we feel makes the uranium supply chain highly vulnerable. Now, a major advantage of uranium is that it's one of the cheapest and cleanest sources of energy. About 10% of the world's electricity comes from uranium or nuclear, and these are powered by over 430 different nuclear reactors in the world, with another 170 in pipeline. Now, based on these reactors in pipeline, we feel that the global demand for uranium should increase by 30% in the next decade and almost double by 2040. Now, 75% of the uranium demand is met by producing uranium mines, and the remaining 25% is met by stockpiles and also recycled uranium. So technically, the uranium market has been in a supply deficit for a long time. Now, when you combine supply and demand forecasts, we feel that the supply deficit should shrink in the next few years and start to widen in the long term. Now, we all know that prices of commodities tend to decrease when supply growth exceeds demand growth. So with the expected shrinkage in uranium supply deficit, we feel that uranium prices could potentially pull back in the near term. Said, we believe over the long term, uranium prices should stabilize around $70 range, which is double the historic average, but 30% below the current price levels. Bottom line, our takeaway is that you should be careful and refrain from investing blindly in uranium juniors just because of the recent trend in uranium prices. Your chances of success increases significantly if you are selective and stick to companies with solid fundamentals, and that's because we feel majors are likely to pursue M&A to secure long-term stable source of supply given the vulnerable supply chain of the uranium market. Now, with all that information, how do you get exposure to the uranium sector? Now, the Global X Uranium ETF is a good platform to get exposure to a wide range of miners and explorers. But in this video, let me give you some names that we like in this space. The table here shows a list of Uranium Juniors and their enterprise value to resource ratios, or the EV to R ratios. As you can see in the table, the average EV to R is $5 a pound. Now, the two most potentially undervalued juniors in this list are GoviX Uranium and Blue Sky Uranium. Now, GoviX has multiple advanced stage projects in Africa, and Blue Sky has an advanced stage project in Argentina. I also want to mention a third junior that we like. That's a uranium explorer called Sky Harbor Resources. They have one of the largest uranium land packages in Canada. Feel free to check out our platform researchfrc.com, and you can access all of the reports of these three companies. That's what I have for you today. As always, if you like our content, please subscribe to our channel, like and share this video. I'll be back with you next week with more ideas.